If you're ready to stop building someone else's dream and start creating your own, join our free community, the Self-Directed Network, at acesmanagementinc.com/school. It's where people leaving their W-2s come together to build freedom, purpose, and momentum toward what's next. Welcome to Life After W-2. I'm your host, John Chan. After 17 years in corporate America, I made the leap to build my own business. It was messier than I thought it would be, but also full of valuable lessons I didn't know I needed. This show is about sharing shifts in mindset, pivots in strategy, and personal changes that come with pursuing financial freedom. You're not alone in this. We're all figuring it out, one step at a time. Welcome to Life After W-2. In this episode, I'm joined by JP Ruiz, a retirement planning expert with deep experience in the self-directed investing space. We break down what most people miss about self-directed retirement accounts, especially solo 401k plans, how they work, why compliance matters, and how to keep your earnings growing tax-free. JP shares insights on choosing the right custodian, understanding fees, and why proper record keeping is essential to stay compliant. We also talk about the growing access to alternative investments and the mindset shift it takes to take control of your own retirement. If you've ever wondered how to use your retirement money to invest in what you know and keep more of your returns, this conversation will give you a clear roadmap. Let's get into it. All right, so today we have a very special guest, JP Ruiz. He's going to help us learn more about self-directed retirement accounts. JP, welcome.
Well, thank you so much, John, and thank you for having me. Hopefully, we can shed some light or rent the veil for some people that are in the fence in regards to self-directing their retirement plans.
Yeah, very cool. So can you tell us a little bit about yourself and your background?
Sure. I've been in a retirement space for over 30 years. I used to work for a company called Universal Pensions, which actually serviced around 3,500 financial institutions, including credit unions. That's around 7,000 financial institutions. My background is the record-keeping 401k plans. Been doing this since the 90s. When 401k plans started to become very popular. I've been a relationship manager for with over seven providers out there, from the industry since the 90s. Worked in the trade desk, and moved up to the ranks and ended up managing our consulting practice around the early 2000s at a company called Ascensus, which I don't know, some people who are in the 401k world know that name very well. I used to manage a third of the company. I ended up specializing in self-directed accounts, and one of my big clients at that point was the Entrust Group, which I ended up working for around 10 years. And I actually own a school. I actually own 3 schools, but this one is now under Ruiz Consulting. It's called the IRA College, which is approved by the American Bankers Association for those individuals wanting to sit for a designation called the Certified IRA Services Professional. Organizations like Pershing, like TD Ameritrade, which is now Schwab, big banks actually hold that particular designation because they knew that questions that are coming up for people who are changing their seasons of their life. Some people are thinking about retiring and are asking those provocative, hard questions, and they need to be able to answer those questions, along with the fact that we have a growing population called, the millennials, which they're no longer the 17-year-olds that we used to call me. I don't know, you may be a millennial yourself, but have accumulated wealth and are moving up in the ranks, not only for working for somebody, but millennials like to work for themselves because they can, maximize their revenue streams by working for multiple people. Thus, in turn, raised up this issue of retirement plans because a lot of them are not familiar with it, nor do they know how to maneuver through that, right? Especially as self-employed individuals, there are 3 basic ones that are available out there, one of which is called a SEP plan, a simple plan, and then the IRS calls it a qualified retirement plan, which is on IRS publication 560 for those of you who are nerds like me, right? So if you want to do more reading, it's the IRS form publication 560. But what does that mean for people? During COVID, there was a stat that I saw out there from a employment agency that there's around 61 million people that earn what we call 1099 wages. And for those of you, like John, you know that those are what you call self-employed individuals. Those are your great target profiles for individuals that want to establish an employer plan. And those are your SEP, Simples, and Solo 401k plan. Although the Solo 401k plan is, I believe, the focus of the topic today, a lot of them have never even heard of it. Now think about it. You're going to start a new business and you don't take the first step and say, I think I'm going to go establish myself a retirement plan. That's probably not even in your radar. But a lot of people miss out on making contributions to a retirement plan for the mere fact that it can actually reduce your taxable income for the year. I get this all the time because I do CPE training as well for CPAs, along with other practitioners. And a lot of them are not familiar with retirement plans. One of them said, I do mergers and acquisitions. Okay, you're a CPA, but you don't do retirement plans because you do something else, right?
Right.
So not everybody's familiar with that. One of the big issues in retirement plans today, especially the solo 401k plan, is the fact that one of the requirements is that you have to develop a record keeping mechanism, which, products out there since 2002. I don't want to throw Fidelity on the bus because they used to be my client. I used to do a lot of their training. They'll set you up a pre-tax account and a Roth account. Is that enough? And the answer is no, it's not. As a matter of fact, if you ask them, who does the record keeping of the pre-tax account, which means there's multiple contributions within that bucket, right? Well, we have the employer do that. And I'm like going, how many employers know how to record keep a 401k plan? Not a whole lot. That's why the issue came up. And my friend and I, who's a tech guy, I had a cushy job, I'm about just writing out my years before I retired. But he said, let's try to fix that for the industry. And that's why we developed a record keeping system called Guardian, to put guardrails in so that individuals who sign up for that do not know how to run a 401k plan will now have the tools, of course, with the assistance of their CPA, certified financial planner, advisor, or whoever it may be, but to be able to run a solo 401k plan appropriately, right? So in other words, not only does it do the separate accounting for the different buckets in a 401k plan, it also does your necessary things like if you wanted to do an in-plan Roth rollover, a technical term for a conversion. Some people may say, is that a spiritual experience? No, it's not, but it could be. Because imagine converting your assets to generally be taxable upon retirement, but converting that to an account that will never be taxed ever again. How do you do that when you only have two buckets or two accounts that are established at a broker dealer? Well, you can't because somebody has to do the government reporting, right? So one of the things that the system does is that it was designed to do the government reporting so that the individual does not have to look for somebody who's knowledgeable on how to do the government reporting, including but not limited to the IRS Form 5500. Sounds intimidating for a lot of people who establish these plans, but those are the necessary pieces that they have to have in a record-keeping system to be able to function not only on a day-to-day basis, but also to function and maintain their plan under compliance.
Let's back it up just at a very basic level. What is the difference between an employer provided K or IRA versus a self-directed IRA or solo 401k?
Okay, the big difference between an employer plan that you participate in, one of the big, puberty. Just kidding. Well, one of the biggest issues is that if you participate in an employer plan, you're relegated to the playground that the employer creates. And what that means is they'll pick and choose a certain number of funds that are within an employer plan. In other words, it's what we call a bundled product in the industry. They bundle a product on behalf of an employer. The employer is responsible to determine how those funds are picked. So let's say out of 30,000 mutual funds out there, how did you come up with the 15? That's what we call an investment policy statement, which is an issue right now because a lot of employers do not have such investment policy statement. They always rely on the advisor. But what if we have, let's say, a demographics of your plan that constitute a lot of people are over 50? Or what if you have a lot of young people? Did they choose enough of the investments that are appropriate or suitable for the employees? In other words, in a nutshell, in an employer plan, the employer chooses everything. There are other plans out there that what we call open architecture plans that are suitable for more of what we call self-direction. And which, by the way, I'm going to bring in the Trump executive order, which a lot of people are not familiar with, which could possibly bring in plans that are offered by employers to offer self-direction as well. Self-direction means that what if you had the platform that establishes the plan? You have to have a document, you have to have a trust account established, and you have to have a record-keeping system. And last but not least, you need to have a way to notify your employees. Those are the 4 steps. In a self-directed plan, you, the participant, gets to choose the investments that you hold under the plan. How exciting, huh? So in other words, instead of, let's say, whatever the list of investments an individual was given to play around with, what if you wanted to invest in something that's not on that list, such as a piece of real estate? Especially for people who are later in their years, they're saying, I cannot handle another market crash. I'm still going to participate in it, but are there other things that I can invest in to leverage the loss or the gains in my plan so that when you average it all out, I still win? such as real estate, private placements is another one that's notes are actually very popular right now, because if you can get, let's say, a 10% secured note, wouldn't you invest in that? Rule of 72, man, you can double your money in 72 months. You can also invest in precious metals, or even for the ones who actually understand it, I'm still trying to crypto. Right. So in other words, in an open architecture model, you have an empty apartment, put your furniture in it under your retirement plan. And that's what self-direction is. Self-direction has taken on and connotated a completely different definition. It used to be, what is self-direction? I go to a bank, I set up a CD, I direct the people to invest in a CD. That's self-direction. However, self-direction in our world means that you're investing in what we call non-traditional investments. And some of the investments that an individual may choose to hold under the retirement plan are the things that they do business in. In other words, they already know that space. But if you talk to the traditional bundle product providers, they're going to say, you know what, we don't play in that playground. Why is that? Because we don't have it electronically in a way that we can handle it. And clients say, what do you mean? We can't handle rental checks. We can't handle dividends coming from a third party. We don't know where they're coming from. And those are what we call outside assets in 401k plans, which could be quite expensive because now it becomes a manual process. We've created a system that allows for self-direction to be made easier, especially in the solo 401k world. How would you like it if you had a checking account under your plan that you can actually buy anything you want, as long as it's within the confines of the law, right? I joke with people. I say, I smoke what I sell. In other words, I have a solo 401k plan myself. In other words, let's say I wanted to buy a lake lot, let's say, in Kentucky. Yeah, I love lake lots because I love the water. And some people say, you can buy that with that? Sure, you can, as long as I'm not buying for myself or from a family member. In other words, it cannot be prohibited. In other words, you cannot have a conflict of interest. Well, I was buying a lake lot, and somebody said, well, when can you close? I said, I can close today if you want to. What do you mean you can close? I can write you a check today out of my 401k plan. Whoa. I said, what is that? That's what this system allows for an individual to do, to invest in things that you really believe in, the ones that you understand, and most of all, the ones that you feel like is going to catapult you in wealth building under a retirement plan, which, by the way, in a retirement plan, a lot of people don't realize it, is that how would you like it that the earnings or the growth, all right, the growth is not taxed until you take it out. So I tell people, what's the moral of the story? Don't take it out, right? And how would you also like it if there's an account in that plan that when you contribute, you don't get the deduction that I was talking about, but the earnings or growth still grow untaxed, or in other words, tax deferred. And if you satisfy certain criteria, how would you like it that everything in that account will never be taxed again? So I ask people, what does that mean? It's tax what? I joke about this. It's tax free. That's different than getting taxed upon taking it out. In other words, it's all yours upon retirement. And to take that a step further, that tax-free nature of the account is even passed on to your beneficiaries. In other words, the account has wealth transfer possibilities, because a lot of individuals who have accumulated a lot of wealth have accumulated their wealth, and those assets are going to be taxed eventually, and that taxation is passed on to the beneficiaries. However, if in that special account that I'm talking about, you will not have to pay taxes ever again, not only for yourself, your spouse, and your beneficiaries. That's a powerful statement. For estate planning purposes, a lot of people that were born between 1946 and 1964, and you might know what they're called, starts with a B, the baby boomer, right? Who have accumulated a lot of wealth in retirement plans. They're not only thinking about, am I going to have enough money for retirement? They're also saying, how do I pass this on to the next generation? And who's going to manage that when I'm gone? And that's what that system is designed to do.
Yeah. What kind of account is that?
That is what we call a designated Roth account under a solo 401k plan. Now, keep in mind, a lot of people like the Roth. They've heard about a Roth, but some of them cannot contribute to Roth, especially the high net worth individuals, the ones who make a lot more money, because you can't be rich to contribute to a Roth. I kid about that. I don't get bogged down on numbers. Why is that? Because the numbers change every year. So what defines who's rich? Right? Now, in a solo 401k plan, you can be as rich as you want, and you can still contribute to a Roth component, and your income does not have any bearing to it. That's a big difference between a self-directed IRA or just a regular IRA than a solo 401k plan. If you're a business, a lot of people choose it. And there's another contribution that can be made in a solo 401k plan that is not traditionally common in 401k plans that have employees offered by an employer, because those plans are subject to what we call non-discrimination tests. In other words, the plan has to be designed not in favor of the rank and file, although the employer wants that a lot. I mean, I want it just to be for me, but that's not the intent of it. The solo 401k plan is intended for what we call a solopreneur, an individual who works for themselves. So in other words, it doesn't mean you can't work for somebody else. I was asked to speak at a convention, and the company name starts with an M, and you fill in the blanks, right? I'm not going to advertise who they are. And there was an advisor that asked me, "Hey, this can I talk to you for a second? This guy works in Silicon Valley, makes a good six-figure income. He participates fully in his employer's plan. In other words, that employer plan that you're talking about.
Mhm.
But he also has a side hustle. He does coding. He codes at night. And the guy does not have a life, but he does make more money at night than he does while working for the employer. You mean to tell me that he can maximize the contribution limit, which is what we call the 415 limit, because they're treated separately as two different employers. One, he's an employee, the other one, he's an employer. And the answer is yes, you can. That 415 limit this year, by the way, is around 70,000. That's a boatload of cash. And if you're married, well, pay your spouse something, and then that spouse can also contribute. But the next thing is, how do you record keep that thing? Which boils back down to, why did we create a record keeping system? Because in order for individuals to be able to respond or answer in the event of an audit of the IRS, you have to be able to have kept good record keeping of your 401k plan, especially if you're investing all over the place. Like you may have an account at Schwab, or you may have an account at a precious metals company, or you may have a crypto account. Somebody has to put all those pieces together, so that not only is it being record kept, it's also reported correctly the moment your assets reach a certain dollar figure, which is 250,000.
Yeah, so I think when I first got into it, I wasn't aware of all these compliance issues.
Hmm.
Why is it so important that you keep good records and follow all the rules and regulations around it?
That's a good question. These plans, like a solo 401k plan, is what we call a qualified retirement plan. So, in other words, if you're a nerd like me, you will look at Section A of the code. Anytime you see that Internal Revenue Code naming convention, that means it's a qualified retirement plan. The reason why it's called qualified, to be qualified, you have to follow certain provisions within that certain section of the code. And one of which is, you have to have proper record keeping system on behalf of your participants, because the plan is designed not for the employer, but in turn, it's for the participants. It just so happens that a solo 401k plan is designed for individuals who do not have any employees. That's why they're participant themselves, so they can maximize it, right? If an individual fails to satisfy one of the provisions, for example, when you reach the age of 73, which is pretty far for a lot of people, but a lot of people who are wealthy as well, they're going back to work as consultants, they are also eligible to have a solo 401k plan. In my example, if you reach age 73, you have to take out what we call a required minimum distribution. In other words, you have to, Uncle Sam says, I've allowed for you to grow your wealth in there. It's my turn. When you reach age 73, you have to take out a small portion out, and I'm going to have to tax you on it. Which, by the way, that Roth that I talked about earlier is not subject to that. Do you know what that means? When you reach age 73, what happens to your account? Nothing. It just continues to grow. What if you reach age 93 and those assets that you have in that Roth continue to compile and grow? Guess what? No taxation for the rest of your life. Now, if you fail to satisfy one of those qualified criteria under 401A, your plan could be what we call disqualified. The disqualification of a plan means that the plan will be viewed as if it was never in existence. I don't mean to scare people with that, but that's one of the things they don't talk about, which is actually written in a brochure that the Department of Labor actually created, your fiduciary responsibilities towards your 401k plan. If it becomes disqualified, you know what that means? All your hard work is now taxable. All the contributions that you've made that were used as a tax deduction, including your employees, your family members, all that becomes taxable. So in other words, what's the moral of the story? Well, stay in compliant, right? So in other words, work with your CPAs. Don't be a lone ranger. Don't be a siler. There's enough people that can advise an individual on running a plan to keep themselves from running afoul.
Yeah. So I think a lot of the custodians that I evaluated when I was going through this, they didn't have an option to or a hub to help you with record keeping. So
Mhm.
if a custodian were to offer that, what would that look like?
If a custodian were to offer that, it's just basically you sign up for the service, and this is what delineates one service from another. All right.
Mm.
Most service providers out there would just basically offer you a document, which is one of the first steps. You have to have an approved document, and there's approved documents out there that they sponsor. and you pay for that. The fee for that can range from 300 for the year or 600 for the year. All right. You sign that document and voila, you have a 401k plan. The missing step, however, is the next step is to develop a trust and step three, a record keeping system in regards to the contributions that are being made, because you have to account for it in the event of an audit. For example, a self-employed individual uses that contribution as a tax deduction under Schedule 1. For those people who file their own tax returns, Schedule 1 talks about, your deductible contributions on Part 2. And one of the lines in there is the contribution made to a SEP, simple, or solo 401k plan, which are the three that I mentioned to you when we first started. In a solo 401k plan, that is used as a deduction on their tax return. However, keep in mind, when I say the maximum amount is $70,000, that's the ultimate maximum, but there may be some underlying limiting factors that could limit your contribution and not reach 70,000, which means those contributions have to be tracked separately, because those contributions also have their own set of rules around them in regards to how much can be contributed. And number two, the timing of when you can actually distribute those assets. Imagine if you didn't know the difference between what we call an employee deferral and an employer contribution, and maybe even an after-tax contribution, and you took money out prematurely because you didn't know what the rules are. That is what we call an operational failure. An operational failure means that your plan could possibly be what? Disqualified. But now it doesn't automatically become disqualified. There is a correction mechanism that the IRS has created. It's called the Employee Plans Compliance Resolution System. As a matter of fact, for those people who are watching this podcast, just type in IRS Fix-It Guide for 401k plans on your, just in the internet, and what will come up is the IRS Fix-It Guide for 401k plans. In other words, here are the common errors that 401k employers that are maintaining a plan have, and here's how to fix it. But if it doesn't fit that list, well, then you have to go through a different steps. But nonetheless, the point is, if you go with a provider that does not have a record keeping system, well, you have to come up with one yourselves. I speak at a lot of events, and I get pulled to the side, and I have, employers, in other words, solopreneurs that pull me to the side and say, JP, man, I'm having such a hard time doing this thing because I'm record keeping my plan using a spreadsheet. And I'm like, okay, I don't know how you're doing that with a spreadsheet because it gets quite complicated. Because let's talk about that, the practicality of it really quick, right? Let's say you want to buy a house and you have, let's say, 3 buckets: your employee contribution, your contribution yourself, your employer contribution as an employer, because it means you played both roles. And let's say you even rolled over dollars from a previous employer or an IRA into that plan. All right. And let's say you buy an investment, all right, using money from all three. Well, you're going to have to figure out how much of that investment you use to purchase from each one of the buckets. And number two, expenses and income also has to go back into those buckets. Imagine the record keeping issues people are saying, like, and I'm like going, you're doing this on a spreadsheet? Okay, whatever. All right. Because that's what I was sold. All right. Again, I don't want to throw people under the bus, but that's the dilemma people are experiencing. Or one of them even said, well, I'm trying to do it through QuickBooks. And I'm like, QuickBooks is not as, how did you do that? I said, well, I'm failing miserably, but I don't have a solution. That's why when I partnered up with a friend of mine who is, one of the top people, and this is in Northern California, because I also live part-time in Northern California. I live part-time in Tennessee. And they said, why don't we solve that for people? Let's build something that will help the masses who wants to set up a solo 401k plan and they don't have to pay the $5,000 or $6,000 that a lot of record keepers charge, and allows for them to be able to record keep their own 401k plan and have success, plus also allow for them to invest in what they know opposed to what they're being sold. All right. That's the big difference. Invest in what you know, not what you're being sold. In other words, if you really want a diversified portfolio, think about it. You want to be in precious metals. You want to be in real estate. You also want to have stuff in the stock market. Then you really are diversified, right? But if all your assets are in the stock market, if that market goes up or down, people panic. You know what I mean? But if you're invested in things that well, you understand the ebbs and flow of a particular investment. That puts you in a better driver's seat. And that's what the Guardian system is. It's a self-administered solo 401k plan that allows for you to invest in what you know.
Yeah, that's a really good explanation because again, that's not something that you hear. I mean, at least in my world, when I
Yeah.
learned about self-directed, it's like, oh, you just take your money and you move it into a self-directed retirement account plan and you invest in what you know, but nothing about the compliance and the paperwork and all that. And then
Hmm.
another thing that popped up was when I was reviewing my parents' retirement plan documents, I looked at the fees and I was blown away by the fees. And then yesterday during one of our calls, an individual who works at a large bank so that not only are you paying the fees on the account balance, but the products that you're being offered also come with management fees that often are more expensive when you invest through your retirement plan than if you were to just go on the street and buy it from whatever brokerage. So is that true with most or all of these traditional accounts where their fees based on a percentage of the account balance?
Now, keep in mind, a lot of these 401k plans have what we call mutual funds underneath it, right? And the
Mhm.
reason why they do that is because traditionally, when you have a 401k plan with employees, you choose the safest investment that an employer could say, I want to limit my liabilities. So I want investment to spread out the investing of those particular assets that I have under the plan. However, that doesn't come for free. It comes with a small what? Fee, right? So, in other words, if you read a prospectus of an individual mutual fund company and you take a look at what we call the expense ratio, fancy smancy term for what's the ratio of the expenses based on whatever the investment is earning. Well, a big portion of that is being shaved off the top on that investment. And that's when you start taking a look at fees start to accumulate. And also, you have to have a record keeper that's connected to what we call the National Sales Clearing Corporation, NSCC, to be able to trade that mutual fund. And they also have their own fee. So not only do you have that fee, they also have that fee. And then also, depending upon who your advisor is, the advisor is also charging a fee. So in other words, we're feed to death. All right. And the reason why I know that is because that's where I used to live in. That's how I used to make my money. I was a record keeper. I was a relationship manager. We sold stuff. We got paid for that. The thing I like about self-direction, which in my legacy, I'm not that young. I'm not that old, although I do look younger because, like you, I'm Asian. So there you go. I want to be able to offer a product that's a flat fee for everybody. How would you like it that that doesn't matter how many assets you have in there. It doesn't matter how many participants you have in there. That it's for yourself, your spouse, or maybe even your kids who end up inheriting the business that you're running, that you're not afraid about having fees increase to the point that it offsets whatever earning you're earning in there. Wouldn't that be great? That's how it's designed because it's designed for the masses. Now, it doesn't come for free. There's a small fee, but it's not into the thousands and thousands of dollars that generally individuals pay somebody else to be able to manage their 401k plan. And here's the good news, however, too. The Secure Act 2.0 allows for employers to be able to have certain tax credits. All right. Not all tax credits are available to solo 401k plans because those tax credits for offering a retirement plan requires that an employer has at least one rank and file employee. There is one tax credit, however, that does not require a rank and file employee. And that's what we call an eligible automatic contribution arrangement. Starting in 2005, if a plan has that provision, a part of their plan, as a part of their plan, they can get up to a $500 tax credit for 3 years just by having that provision. It doesn't mean you have to exercise it. It just means that your document has to have it. The document that we've chosen for the Guardian system actually contains that in what we call a good faith amendment. For those people who have ever had a 401k plan, they just keep tacking on documents to it. Why? Because legislation keeps getting passed since the last time that document was amended. In other words, that good faith amendment needs to be comprehensive enough to include those provisions that are beneficial for employers. One of those are your eligible automatic contribution arrangement. Since they're their employer and they're also the employee and they don't have any rank and file employees, how would you like to get a $500 tax credit on your business tax return on an IRS? I'm going to go nerdy on you again. It's the IRS form 8881, and then they have to file an IRS form 3800 called the business credit. For those of you who are jotting notes down, look it up. Then at least you know I'm not just making this up, right? IRS form 3800 on part 2, I believe. That's where they would put the tax credit and reduce your tax liability for the year just by having that provisions under the plan. So if let's say you're getting charged, let's say $1,500 for the plan, how would you like it? You get a $500 tax credit. It's actually only costing you $1,000 to have the plan with unlimited participants, unlimited investments, as well as a free checking account. So you can actually invest in the things that you would like. You won't find that anywhere. In other words, a flat fee to be able to invest in what you know. That's a great message to deliver out there in the community.
Yeah, for sure. Because again, I was just blown away with how much my parents were just getting nickel and dimed, and
Mhm.
so big reason why I wanted to move their money into a self-directed. It's like I don't even know who these people are, who's making what. I think it was one of Tony Robbins' books. It said mutual funds can have a 5-star rating even if they have one fund that is performs well, and the 99 others are failing,
That's
but they
right.
can still get that 5-star rating, which I think is unbelievable.
Well, it used to be that people never complained. Like in the
Mhm.
'90s when Fidelity Magellan was, before it got to be a closed fund, you had a what is it, 1% expense ratio up to 2% expense ratio, but you're earning 79%, so it really didn't matter. But those days are long gone. I mean, we're not earning that much anymore. So if you're earning 10%, you're really earning 8. That's a boatload of cash in comparison to the amount of assets that they're holding. Again, I don't want to throw them under the bus. There is a place for stocks, bonds, and mutual funds in a retirement plan. It just so happens that they have a monopoly on it. There are other things that people have an appetite for that should be allowed to invest in whatever they want. Well, let's talk about the democratization of alternative investments in 401k plans. In mid part of this year, the current administration said that they need the Treasury Department, the Department of Labor, and the SEC needs to take a look at allowing for these alternative investments to be held in 401k plans, right? Regular 401k plans with employees. And here are the different investments that they said it could be held, right? One of which is crypto, right? I still don't understand crypto because I'm in a different era, but I hear that it's doing really well. You can have private equities, which means your private placements or venture capitals or whatever it may be, that allows for an individual to say, you know what, I want to invest in that. Real estate. That's a wonderful thing, especially imagine if you're an owner of a company, you don't plan on retiring, but you want your retirement assets to go and continue to grow bigger, right? Imagine if that was under a Roth and say, you know what, I want to buy that apartment complex. You can't do that right now. Or if you did, the employer could get in trouble because if that investment goes bad, guess what? The buck stops at the employer, right? So, but now if you have employer plans with employees, it could not be feasible because the current administration is saying to the three entities, two of which is under the cabinet, and then the other one also is a part of that. Hey, go figure it out. Figure out how we can allow for these types of investments to be held under these plans. Now it's come to the limelight. People are going, I didn't know you could invest in crypto. How come that was never offered to me before? Well, now it may have to be offered, but keep in mind, there's always a time frame when the administration, let's say, issues an executive order before guidance is created. All right. Let's say it was passed in July of this year. They have 180 days. In other words, 6 months. I don't know why I didn't just say 6 months, but 6 months to come up with guidance. And from there, the industry is allowed to comment on those guidance to see whether or not it's going to work. But nonetheless, the important news here is that they're trying to figure out a way for individuals to be able to invest in, again, what they know or what they feel like is going to propel their wealth under a retirement plan, opposed to what they're just being sold as available, right? You're playing your bullpen. You no longer can do that. You no longer have to do that. You may be allowed to invest in something that you might like. You might like precious metals. You know what I'm saying? When precious metals go up, something else goes down. When precious metals go down, something else goes up. But wouldn't you like to have both? So that in the seesaw of things, on the average, you're doing great. Again, it's I think it's going to be a benefit for the masses. Now, how does Guardian play in that? We've already been contacted by record keepers. They're saying our systems are not designed for that, but your system is. Can we mirror the plan record keeping system that we have with what you have to allow for individuals that want to do self direction to be able to do that? You know what that means? It's going to open it up for the masses to be able to say, you know what? I'm willing to take the risk of 10% of my portfolio to invest in crypto because I've been doing research on that and I'm really interested in doing that. It's not a big risk, 10%. It's still a huge chunk, but now they're going to be allowed to be able to do that. Or I'd like to invest in this company, which I believe is going to be the next Facebook, right? I want to invest 5% of my portfolio for that. Hey, now it's going to be an allowable thing. And hopefully they will create legislation or regulations that will limit the liability of the employer, which will make the employer feel a little bit more comfortable by allowing these particular types of windows within their 401k plan to invest in alternative investments.
Yeah, I think when companies don't have to cover themselves, it's going to open up a lot more opportunities. Everyone's just always, I mean, even as a kid growing up, everyone's always afraid of getting sued in this country.
Yeah,
Yeah.
yeah, yeah.
So I have a question for you. I know there you spit out a lot of IRS publications and forms
Mhm.
and all that.
Yeah.
In the simplest way, if someone is thinking about converting an old retirement account into a self-directed, they're on the fence or intimidated by the process. Like, what's the mindset shift you'd want them to have?
The mindset shift I want them to have is number one, it's not that difficult. In our process of moving from one plan to another, first off, we need to clarify that if it's two different types of plans, that is what we call a rollover. It has to be in the form of what we call a rollover because it has to be reported. If you're leaving one plan and going to another employer's plan or another type of plan, that always has to be reported because the IRS wants to know where you're going. However, if you have an existing solo 401k plan in another institution, and all you're moving is moving the same plan to another institution, that is what we call a transfer. Although it sounds the same, they're really not because a transfer should not be reportable, right? So if somebody let's take a look at take a look at a scenario. Somebody goes, I'm thinking about retiring, but I'm still going to continue to do my business, all right? And I'm going to be a consultant, which a lot of them are doing that. Some of them are losing their jobs, whether it be voluntary or involuntary. And I laugh about that in a nervous way because some employers are laying off people and then hiring them back as consultants. That means that you have what we call a trigger. That's what we call that's what we call that in the industry. In other words, you have a distributable event. In other words, in a 401k plan, you can't just take your money out. Either you have to die, become disabled, reach normal retirement age, or separate from service. In some cases, a divorce. Let's say you don't have any of that and you're working for an employer. You can't take your money out. But if you do have a life event that allows for you to take money out of the plan, all right, those are just examples of it. And you wanted to do self-direction. Number one, you can directly roll over your previous employer plan into a self-directed IRA. And of course, if you have pre-tax dollars in there, it's going to go to a traditional. And if you have Roth dollars in there, it's going to go to a Roth. You don't want to go, you don't want to convert you don't want to move your tax-free dollars to a taxable account. You want to move it tax-free to tax-free, right?
Right.
So that's one way to move that. And that is what we call a direct rollover. All you have to do is contact your previous employer, tell them where your new IRA is established, whether it be self-directed or not, and tell them, I'd like for you to directly roll that over to this name of this custodian for the benefit of your name. Why is that very important? Because as long as you don't touch those dollars and it's sent directly, whether it be by check to you and passed on to the custodian or not, as long as the check or wire or whatever it may be is made payable to the receiving institution, you never received it, right, as spendable cash. It's non-taxable. That's what we call a direct rollover. Another route that an individual could take is to roll it over into a new solo 401k plan. Let's say they got laid off, but they're still going to continue to their employment through self-employment. They're working as a consultant for the organization as well as other people. That is also a direct rollover. That direct rollover, in other words, comes from your previous employer or even an IRA, only traditional, not Roth. There's a reason for that. Those assets can be directly rolled over into your solo 401k plan. And you, the individual who has it in your solo 401k plan, would need to put it in the appropriate buckets. Think about a 401k plan having two IRAs inside it, right? And actually more. You have your pre-tax, you have your Roth, you have your rollover. Just put it in the right bucket. With the appropriate record keeping system, it makes it very, very, very simple. The system was created to be intuitive enough so that whatever your employer says, well, these are what you have, and you can also see that in your statement, put it in the appropriate buckets and continue on your tax deferred journey under your own solo 401k plan or an IRA, no longer be dependent upon that employer.
It just a wealth of knowledge, things that I had no clue that you could do. I mean, there's
Mhm.
just so much out there. Like, how do you keep up with all of this?
It's not that it's well, you when you've been doing this for 30 years, you were around when they passed the list. So one of my jobs running a consulting firm is to request to everybody and say, hey, what does this new piece of legislation mean? And hopefully I can drill it down to the point that, we're not watering it down so people don't, miss the detail, but yet keep it simple enough so people would know the language, because language is very different in the retirement space. And number two, how to facilitate that process so that you can use that language to communicate back and forth and with the different institutions that you're working with, managing your retirement plan asset.
Yeah. So when you are looking for a custodian or I guess a plan provider, what are
Mhm.
some of the most important questions you should be asking?
I believe fees are number one. How much are you charging?
Mhm.
And what capabilities does the custodian have from when it comes to their systems? And let me explain to you what that means. Let's say you go with a custodian. Most custodians out there use the standard trust accounting systems that basically you can see your assets, but if you wanted to initiate a transaction, well, you're gonna have to complete a form
Mhm.
or forms or maybe even a stack of forms to be even get started, right? Number one, are you equipped to complete those forms or understand what you're supposed to be doing in those forms? Because what if you don't have enough information in there? Guess what? The custodian will reject it, right? So, what is the ease of interacting with a custodian in regards to the account that you've established? There are also other systems out there that you can do it online. Not a whole lot of them. Heritage is one of them that actually is using one of the systems that we've developed called Lion, which actually allows for an individual to interact electronically. So on a Saturday evening, that's your day off, and you wanted to do transactions. You're not faced with spending hours completing forms. You can actually just do that within your portal and communicate with your custodian so that Monday it's already at their desk, ready for you to go ahead and transact your transactions that you want, right? Instead of waiting a long time. Right. So let me give you an example. In a solo 401k plan, you have assets that have never been taxed before, and you want to put that in an account that will never be taxed ever again. I kind of alluded to that originally as what we call an in-plan Roth rollover, the technical term for what we call a conversion.
Mhm.
All right. I've been told in some organizations that will take weeks to do. And I'm like going, what are you doing that it takes you weeks? In the Guardian system, it takes you 10 seconds because it's all an accounting function that moves it from one bucket to the other. And the system will automatically generate what we call a tax reporting instrument at the end of the year. And that is what we call the IRS Form 1099-R. The importance of showing that movement, especially from an accounting perspective, as a CPA perspective, is that in the event of an audit, wouldn't it be nice to be able to show what you did on your record keeping system so that as the IRS auditor comes in, have them sit down with some milk and cookies and say, "What do you want to see?" Okay, in this transaction, how did you get that into the Roth? Well, on this date, this is what I moved, whether it be in kind, in other words, a piece of real estate from one bucket to another, or cash. You have an audit trail. That's the point. All right. And also, did you issue a 1099? Well, tell you what, click on that folder that says IRS forms. There's that 1099-R, and here's my tax return. I actually included that in my tax return. What do you think the IRS auditor is going to say? Oh, this guy or gal has their ducks in a row. And as a matter of fact, here's my CPA, and we worked through that whole transaction, and voila, that's my proof that I'm running my plan and I'm keeping good records of which, by the way, that's on the IRS website. Keep good records so you can prove it to them to be able to pass a lot of those questions.
I think that's amazing because even when like I'm helping my mom deploy her money into certain things, she's getting paid back on a loan. And
Mhm.
it took weeks for that cash to be reflected in her account as because I had to call them and say, what's going on? It's just cash. Shouldn't this just show up? Say, oh, we have to process it. We have to do this. We have to apply it to the right asset. They're just doing everything. And to deploy money, you have to like, fill out a PDF and submit that. It's just I saw the system at Heritage, and to be able to just do everything through the portal and have it done quickly and pretty much seconds is a huge game changer. Plus the compliance part of it too, because again, coming to the realization that there are a lot of ways that you can fail at this.
Yeah.
So making sure that you have all the right records and an audit trails that, essentially to make sure that you can show this is what I'm doing. I'm doing everything the right way. I'm doing it within the guidelines.
Mhm.
Please leave me alone.
That's right. And it's categorized based on the transaction that you're doing. So, in other words, if you want to just see all the contributions that I've made, it actually keeps a record of each one of the contributions, how much contributions were made, which should match your tax return, right? And then from there, once that is done, how did you do your investments? Do you have backup documentation? The backup documentation is very important because, for example, in IRAs under Section 1.219 of the Treasury regulations, a custodian must have a vault, whether it be electronic or physical vault that keeps track of all the backup deeds of trust or whatever it may be that you purchased, or maybe a private placement subscription agreement. Now, wouldn't it be nice if you had an electronic filing system that's built into the system that you just upload that and that keeps track of that particular investment under that investment's name? Well, in a 401k plan, guess who the custodian is? It's the employer. The employer cannot rely on somebody else to do their record keeping for them. They're doing it themselves, right? So in other words, if you don't have documentation to back it up, guess whose fault it is? It's yours. You just only thing you gotta do is upload it, and you have it all electronically within the system so that it passes muster for all the different questions an auditor would ask for. Right? It's not the magic pill for everything because garbage in, garbage out. In other words, garbage information in, garbage information out. But
Right.
at least now they have a tool to be able to accomplish what the IRS and the code is actually requiring of them.
Yeah. It's just things that people need to understand when they go down this route. It is a very powerful tool, but you also have to make sure you're following all the rules.
That's right. Well, you're getting a big bang for. How would you like to reduce your taxable income? Let's say if you're under 50 of up to $70,000. And if you're 50 and older, add another 7,500 to that. However, if you're age 60 to 63 under the Secure Act 2.0, the catch-up contribution, which is what I'm referring to, is 11,250 this year. So if you have enough income to support making a $70,000 contribution, right? Putting in your employee and your employer contribution, and when you get to 70,000, you can put an additional 11,250 if you're age 60 to 63, that's a boatload of cash, my friend, that you can actually not only reduce your taxable income, but I tell people this, it's not just a deduction, you get to keep it too. Somebody was telling me, man, I got a tax deduction because I bought a truck, right? You know,
Mm.
100% depreciation of the truck. And I'm like, okay, did you know when you left that dealership, that your deduction is not worth what you purchased it? I knew that, but what else can I do? I said, do you know you could have put that in a retirement plan? Because your last truck was still fairly new.
Yeah.
You would put that in a retirement plan and invest in things that you know. You're a realtor. Invest in real estate. You can do that? Well, 70,000 is not enough to buy a piece of yeah, but you do hard money lending, don't you? I do, outside of a retirement plan. But how would you like it in a retirement plan that the interest that you're earning is not taxed until you take it out? Wait a minute. I've never heard of that before. That's been around forever. Since ERISA, I mean, when ERISA was passed in '74, my word, it's been around. It's just that people have not been educated on it, right? So that's our job. It's our mission too, is to be able to educate the community. Yeah.
Yeah, just share what's possible. You've been working on it for decades. So I appreciate you coming on and sharing all of this wealth of information. JP, how can you help people and how can people reach out to you and work with you?
Well, what they could do is reach out to one of our providers, which is Heritage IRA.
Yeah, absolutely. And then in the description, we'll also have a booking link that you can talk to someone just specifically about your situation and give you the best solutions.
Yeah, consultation. Yeah, for
Yeah.
right. That's right. And if they get stuck, guess what? JP, we have a question. So,
Yeah, we'll make sure to have all that information in the description for everyone. JP, again, thank you so much for coming on and sharing that wealth of information that you have in your brain.
well, thank you for having me, and hopefully we can get together again sometime soon and chat about this thing.
Yeah, absolutely.
All right.
That's it for today's episode of Life After W2. I'm John Chan, and I appreciate you tuning in. If this episode resonated with you, share it with a friend who's ready to take control of their financial future. And if you're curious about how self-directed retirement accounts can unlock opportunities in alternative investing, grab our free guide. It's packed with insights to help you get started. The link's in the description. See you next time.